In our first video, we focused on the acquisition cost of our plant assets. We'll now discuss a topic known as depreciation. What is depreciation? It is a system or a process of taking the cost of our long-term assets and expensing that cost over what's known as the asset's useful life. Depreciation is not an asset valuation. So people always say it is a decline in value. That is not true. Again, it is a process of cost allocation, meaning that the cost of those planned assets that we discussed in the first video, those costs will become an expense over time through a process known as depreciation. All of our plant assets depreciate except for land. Land does not depreciate because land does not have a defined useful life like all of the other assets. Perhaps you're saying, well, why is depreciation important? I'm glad you asked that question. Well, because the buildings, the equipment, the delivery truck, they're all been used to earn revenue for the business organization. And the cost of those assets over time becomes an expense. So we're still trying to match the expense and revenue recognition, the matching principle in the same accounting period. We can't just recognize the revenue from the use of this asset and not look at the actual cost of those assets becoming an expense over time. So for example, here's one of my drawings. Like it? Let's say we have this brand new delivery truck. Initially, we'll look at the cost of the truck. And the rule says any cost to acquire this asset will be included in the planned asset account. But over time, that asset is going to be used. It has what's called a defined useful life. Useful life says, how long can I use this asset to earn revenue for the business organization? Now, useful life is an estimated amount, but in accounting, we have charts, we have tables that tell us what is the expected useful life of different type of assets. For example, for a commercial building, useful life is 39 years. Residential property, useful life is 27 and a half years. For an asset, if it's considered to be a small size asset, 5 years, larger asset, 7 years. So we do have these tables that help us to define the useful life of different types of assets. Then we have salvage value. Salvage value is the estimated value of the asset at the end of the asset's useful life. So we're saying once the asset has been used, how much can we get for that asset? That figure is known as the salvage value of the asset. Again, that amount is also estimated, but it's estimated based upon historical information. We'll look at what amount did I get for these delivery trucks in the past when they were fully depreciated. And so we'll look at how do we use salvage value, cost, and useful life to record what's called depreciation expense. Now, each of these planned assets have a contra asset account called accumulated depreciation. This account is used to keep track of how much of the asset's cost has been depreciated or expensed so far. There are different methods for depreciation: the straight line approach, decline and balance method, and what's called the units of activity approach. Straight line, as you can see, is used by most companies 83% of the time. So we'll teach you about the straight line method, but we'll also look at the other method used to record depreciation. So you ready? You excited? Let's go. Bill's Pizza purchased a small delivery truck that costs $13,000. Salvage value $1,000. Useful life is 5 years or 100,000 miles. We're going to use these different methods to determine what should be the amount of the depreciation on an annual basis. First, straight line. Straight line, we take the cost of the asset minus the salvage. That gives us what's known as the asset's depreciable cost. Depreciable costs represent the amount of the asset's cost that we're going to expense over the asset's useful life. So this $12,000 will be expensed over the next 5 years in an equal amount. Therefore, we're going to expense each year a total of $2,400. So straight line, take the cost minus the salvage value to get your depreciable cost. Divide that by the useful life of the asset to get the amount of your annual depreciation expense. So with the straight line, the amount is going to be the same each year over the asset's useful life. So notice that at the end of 5 years, it has a book value of $1,000, the same as the asset salvage value, because this is the expected value of the asset at the end of the asset's useful life. So we will make this journal entry each year for the next 5 years, debit the expense account, credit the contra account known as accumulated depreciation. Okay? The next method, well, before I go there, assume the truck was bought on April 1st, 2017, meaning that we did not have the asset for the entire year. This is known as partial year depreciation. So we know the amount is $2,400 for a full year, but we had it from April through December, which represents a 9-month period. So take the annual amount of depreciation times 9/12 to get the amount to be expensed for this current year. That amount would total $1,800. Now, because it was bought in mid-April and April, notice that in 2022, we're going to expense the cost during the first 3 months of that year. So we got 4 full years here, 9 months in 2017, 3 months in 2022. Therefore, in total, it would be a 5-year period we're going to expense the cost of the asset. So in 2017, if we bought it in April, the expense will only be for $1,800 rather than the entire $2,400. Okay? Next, we have what's called the declining balance method, which is an accelerated approach. With this approach, we're going to expense a greater amount of the asset's cost in the earlier years and a smaller amount of the asset's cost in the latter years. With the declining balance method, we're going to double the straight line rate of depreciation, and the rate is applied to the book value with the declining balance approach. Did you get that? Let me show you. So with the declining balance method, give an example. We look at the beginning book value of the asset. We bought the asset in 2017 for $13,000. That would be the asset's beginning book value. To get the declining balance rate, first get your straight line rate of depreciation And let me talk about that for a minute. To get the straight line rate appreciation, you take 100% divided by the number of years of the asset's useful life. Again, take 100% divided by the number of years of the asset useful life. So if there's a 5-year useful life, like what we have, the straight line rate is going to be 20%. 100% divided by 5 gives us 20%. The decline and balance method would be double the straight line rate of depreciation. So a straight line is 20%, take that times 2 to get 40%. All right? So in our first year, take your beginning book value times your rate to get the amount of your annual expense. So in year 1, we'll expense the account in amount of $5,200. Which means at the end of year 1, the ending book value will be $7,800 because book value is original cost minus accumulated depreciation. Your year 2, so in 2017, debit the expense account, credit the contra account accumulated depreciation. Now for year 2, your year 1 ending book value becomes your year 2 beginning book value. Take that amount times 40%. The expense now would be $3,120. You want to keep track of your accumulated depreciation. So at the end of those first 2 years, we've expensed so far $8,320. Our year 2 book value is $4,680. Again, book value would be original cost, $13,000 minus your accumulated depreciation. Book value would be $4,680. Year 3 beginning book value, $4,680. Take it times 40%. The expense amount would be $1,872. At the end of year 3, we expend a total of $10,192. That gives us a year 3 ending book value of $2,808. Again, book value is original cost less accumulated depreciation. Same thing for year 4. Take it times 40%. We'll spend $1,123. We spent so far $11,315. Ending book value would be $1,685. Now recall that the depreciable cost of this asset was how much? Do you remember? Do you? Okay. It was $12,000. Meaning that we cannot expense beyond the asset's depreciable cost. So for year 5, the amount we can only expense is $685 because we've expensed through the first 4 years $11,315. So we're going to expense in year 5 the additional $685 to get our total depreciable cost of $12,000. So again, at the end of the asset's useful life, the total in the contra account accumulated depreciation will represent the depreciable cost of the asset. That's why if you take this number times 40%, it gives you $674, but we have to use $685 to make the adjustment so that the total amount depreciated at the end of 5 years is $12,000, which was the asset's depreciable cost. Did you catch that? I'm going to stop this video right here and I'm going to come back with a third method called the units of production.